Welcome back. Previously we have discussed in brief the Ind AS standards. Let us continue with the rest of the standards as per the Ind AS. These are the list of IFRS corresponding to Ind AS notified by the MCA, and some of the standards which we have discussed in the previous session may not be shown in this slide. And previously we were discussing about the Ind AS 101 onwards, Ind AS 101 until Ind AS 16, that is leases. We will discuss about the further Ind AS 1 till Ind AS 41. We will continue with that. Next is Ind AS 1. Presentation of financial statement. Indian Accounting Standard 1, otherwise known as Presentation of Financial Statement. Earlier it was known as Accounting Standard 1. Now after the convergence, from this standard onwards it will be Ind AS 1, because these were the standards which were in operation or which has been used by the corporate concern even before the convergence. That is why it is known as 101. And the new set of standards after the convergence is known as IFRS 101. So anyway, what is the scope of this particular standard? This standard prescribes the basis for the presentation of general purpose financial statements to ensure the comparability both with the entities' financial statements of previous period and with the financial statement of other entities. It set out overall requirement for the presentation of financial statements, guidelines for their structure and minimum requirement of their content. Actually, the content of this standard means the companies that are complying as per the Ind AS has to present their financial statement as per the standard set by the Ind AS, and the main objective is to present the financial statements in a uniform pattern so that there will be transparency, and moreover it can be compared with the other financial statements. Other financial statements we have discussed about this area. The financial statement of the same company can be compared with the financial statement of the previous years, or the financial statement of that company can be compared with the financial statement of the other company. So all this is possible when the financial statements prepared by the company or the companies, if they follow a similar pattern, and that uniformity can be implemented or maintained by following Ind AS 1. So Ind AS 1 or Ind AS standards. So, and Ind AS 1 specifically mention about presenting the financial statements as per the Ind AS standards. Next one, Ind AS 2, inventories. I believe you all know what is meant by inventory. Inventory is actually a common term given to materials. Materials means from raw materials to finished goods, we can commonly use a term inventory. Actually, the material is at the initial stage, a material is known as raw materials. Once it is passed through various processes within the company, the raw materials may be changed to finished goods, and it may be changed to partially finished goods, or it may, in between the finished goods and the or partly finished goods and the raw materials, there is another set of item that is known as work in progress. So the material or the raw material is converted into raw materials into finished goods after going through various processes, and the result of this process is termed as, initially it will be called as raw materials, after that work in progress, after that partially finished goods. In some situation it will be partially finished goods, in some situation it will be finished goods, and finally it is known as stock. So inventory is the term that can be given to all these situations. All these situations means the material or the output of all these processes. That is known as inventory. And Ind AS 2 deals with inventories. The objective of this standard is to prescribe the accounting treatment for inventories. How the inventories can be treated. There is a certain peculiar accounting practices that has to be followed for identifying the value of inventories and how they have to be presented in the financial statement. Primary use in the accounting for inventory is the amount of cost to be recognized as an asset and carry forward until the related revenue are recognized. These standards deal with the determination how the value of the inventory can be identified. So it deals with determination of cost and its subsequent recognition as an expenses, including any write down to net realizable value. It also provides guidance on the cost formulas that are used to assign cost to inventories. So, any theoretical aspects with regard to inventories, especially in presenting the inventories in the financial statement, how it can be identified, how the value can be set on that particular inventory. All these are mentioned in detail in the Ind AS 2. Next one, Ind AS 7, and you might see that after 2 it is directly going to 7. It may be due to some of the standards might have been revised, or it might be amended to some other standard, or some of the standards might be suspended. So after Ind AS 2 we will go into Ind AS 7, and Ind AS 7 deals with statement of cash flows. Cash flows basically means what is the flow of cash within the business. There are two types of flows, inflows as well as outflow. Inflow means any sort of income or revenue to the company. Such types of flows is known as cash inflows, and cash outflows means any amount spent by the company, just like expenses or losses, like that. That is known as cash outflow. And the statement of cash flows depicts the what is the position of cash flow within the business. So as per this standard, the information about the cash flows of an entity is useful in providing users of financial statement with a basis to assess the ability of the entity to generate cash and the cash equivalents and the needs of the entity to utilize those cash flows. One of the main aspects with regard to a concern is what is the liquidity position of the concern. Liquidity means what is the cash position of the concern, how the company can generate cash quickly, what is the position of the company with regard to cash, whether they have sufficient cash in hand, or whether that is known as liquidity. The economic decisions that are taken by users means the investors, require an evaluation of the ability of an entity to generate cash. In simple terms, we can say the liquidity of the concern. If the concern have sufficient liquidity position, that means it has the ability to generate cash. So, as an investor, we will invest in a concern that has a favorable liquidity position. So, objective of this standard is to require the provision of information about the historical changes in cash and cash equivalents of an entity by means of a statement of cash flow which classifies cash flows during the period from operating, investing and financial activity. You will learn about this area, this cash flow, how the cash flow of a concern can be identified. For the purpose of studying in detail what is the position of cash flow, from what all sources cash has been collected by the company, or for what all areas in which the cash has been spent by the company. That is a very relevant area, and usually on the analysis of operating, investing and financial areas will give a clear-cut idea about what is the flow of cash within the business. And the statement of cash flow, otherwise it is known as cash flow statement. You will learn about this cash flow statement in the next semester, not in the next semester, in the higher semester. Usually in the final year accounting, you will learn in detail what is meant by cash flow statement, why is it prepared, and the statement of cash flow deals with the inflow and outflow of cash after studying operating, investing and financial activity. It is a very important standard, remember it. So Ind AS 7 deals with statement of cash flows. Earlier Ind AS 3 was known as statement of cash flow. It was not known as statement of cash flow, it was known as cash flow statement. Now after the convergence, now it is known as Ind AS 7, that is statement of cash flows. Next one, Ind AS 8, accounting policies changes in accounting estimates and errors. Next one, Ind AS 8 deals with accounting policies, changes in accounting estimates and errors. As the title suggests, the objective of this standard is to prescribe the criteria for selecting and changing accounting policies. There is a certain criteria for selecting a certain type of accounting policy, and once it is selected, it is not easy to change quickly. There are certain steps that has to be followed for selecting as well as making necessary changes in the accounting policies. And Ind AS 8 specifies what are the criteria for selecting, and at the same time what are the steps that has to be followed while changing the accounting policies. So together with the accounting treatment and disclosure of changes in the accounting policies, changes in accounting estimates and correction of error, how the errors in the financial statements are corrected, there are certain procedures for that. The standard is intended to enhance the relevance and reliability of an entity's financial statement. That is the main aspect. If there is a certain pattern or there are certain steps for implementing the accounting policies, and there are certain prescribed format for making necessary changes in the accounting policies, it will ultimately ensure the reliability and relevance of the financial statement, and the same financial statement will be rigid, it will be uniform, and it will be transparent, that ultimately helps the investors in analyzing and studying the financial statement and helps in taking correct decisions. The standard is intended to enhance the relevance and reliability of an entity's financial statements and the comparability of those financial statements over time with the financial statement of other entities. So in order to ensure that Ind AS 8 is to be complied by the companies that are presenting their financial statements as per the Ind AS standards. So next one. Ind AS 10, events after the reporting period. Ind AS 10 is events after the reporting period. So the meaning of events after reporting period means those events favorable and unfavorable within the business that occurs between the end of the reporting period and the date when the financial statements are approved by the board of directors in case of a company and by the corresponding approving authority in case of other forms of entities for issue. So that is known as events after reporting period. That certain financial transaction or financial events that occur after the presentation of financial statement, and once the statement is presented, and there is a certain time gap between the presentation and the approval of financial statement by the concerned authority. So any financial event that occurs in between that period is known as events after the reporting period. And IAS 10 specifically mentioned about what are the procedures that has to be followed when a company report an event after the reporting period. So Ind AS 10 deals with events after reporting period. Next one, Ind AS 12 deals with income tax. As the title suggests, it deals with all those financial transactions relating to income taxes of the corporate concern. And in this standard, it specifies what are the steps that has to be followed by a corporate concern with regard to the income taxes. And it specifically mentioned about what are the steps that has to be followed and how these taxes has to be dealt and presented in the financial statement. And Ind AS 12 specifically deals with income taxes relating to the concerns that comply with Ind AS standards. Next one, Ind AS 16, property, plant and equipment. as the title suggests, how the company is dealing the transaction relating to the properties of the concern or the plant and equipments of the concern, and how the company is making necessary investments in these areas, and how it is to be presented in the financial statement so that the users of the financial statement get a clear information about how the investments or financial transactions of the company with regard to property, plant and equipment are dealt. Because the investors want to invest their hard earned money in the company or the business, so they have the right to know what is the position or the situation the company is going through in dealing with property or investment in property, plant and equipment. So the objective of the standard is to prescribe the accounting treatment for property, plant and equipment. Why? So that the users of the financial statement can get information about entities' investments in this particular field and the changes they have made in the investment also. So that is with regard to Ind AS 16. Next one, employee benefits. The objective of this standard is to prescribe the accounting and disclosure for employee benefits. There are many types of employee benefits that are offered by the company to its employees, and as per the standards, it prescribes that the accounting of how the company is disclosing the transactions relating to the employee's benefit. The standard requires an entity to recognize a liability when a company employee has provided service in exchange for employee benefit to be paid in the future. That is the amount that is paid by the company to its employee during the retirement or after retirement, like that. An expense when the entity consumes the economic benefit arising from service provided by an employee in exchange for the employee benefit. What are the expenses that are dealt by the entity with regard to the employee benefit that is to be given to the employee in the future period? So any transaction relating to the employee benefit are dealt as per the Ind AS 19 if the company is following as per the Ind AS standards, and Ind AS 19 specifically deal with all those transactions with regard to employee benefits. Next is Ind AS 20. It deals with accounting of government grants and government assistance. Many companies or corporate concerns get some type of grants and assistance from the government directly. It may be in the form of providing grants in the form of resources from the government to the companies, or any type of assistance in the form of subsidies or deductions like that. So whenever there is any financial transactions with regard to government grants or any sort of assistance from the government to a corporate concern that is complying as per the Ind AS, and Ind AS 20 specifically mention about the steps that has to be followed with regard to the accounting of government grants and disclosure of government assistance. Government assistance or government grants is action by government designed to provide a economic benefit specific to an entity or range of entities qualifying under certain criteria, just like the point which I have mentioned earlier. That is known as government assistance. And government grants are assistance by government in the form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to the operation activities of the entity. So in transaction with regard to government grants and assistance, it has to be compliant as per the Ind AS 20. Next one, effects of changes in foreign exchange rates. In a globalized situation, every corporate concern will have its business dealings or transactions not only within our country but also with the businesses outside our country. So when there is a financial transaction or a business dealings with outside country, definitely there will be some aspects with regard to foreign exchange rates. So the effect of changes in foreign exchange rate are dealt as per Ind AS 21. Next one, Indian Accounting Standard 23. Ind AS 23 deals with borrowing cost. Borrowing costs are that are directly attributable to the acquisition, construction or production of a qualifying asset from part of the cost of that asset. Other borrowing costs are recognized as an expense. So before we go into borrowing costs, first of all it is related to qualifying asset. So what is meant by qualifying asset? A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or a sale. If you look for an example like a building or a land, it's actually or it is valued in its realizable value or in its existing market price. It is in use, it can be used, or it is actually in a usable form, not in the form of in the middle of a process like that. It's a finished item. Building, it's a finished item. Land, it is actually a complete item. There is no sentence or term as the land is growing or land will be matured after 5 years. There is no such thing. All these are complete items, such assets, and there are some assets that is in the process of completing. Usually it occurs in the case of biological assets, for example agriculture. If I own a certain acres of mangroves is not grown or we can get the product from the mangrove trees overnight. It needs time to grow and shed fruits. It needs time. It will take time from a tree sapling to a full grown tree. So such items are known as biological asset. Usually it comes in the field of agriculture and it will take some time to come to its full form. That is known as qualifying asset. So any transactions with regard to qualifying asset is known as borrowing cost, and the borrowing costs are interest and other costs that our entity incurs in connection with the borrowing of funds for that particular asset. That is known as borrowing cost. So any transactions with regard to borrowing cost is specified in the Ind AS 23, and the company or corporate concerns complying with IND standards as to follow Ind AS 23 for dealing with transactions relating to borrowing cost. I believe you have understand the concept of borrowing cost. Borrowing cost deals with or relating to qualifying asset, and qualifying assets are those assets that are necessarily take a substantial period of time to get ready for its intended use, or we can say for its complete form. Ind AS 24 deal with related party disclosure. Actually, related party disclosure they come in terms with the aspects of business combinations. I believe you all know what is the business combination, or the transactions between parent company, subsidiary company, like that. So when one concern take over another concern, the company that is taking over other concern is known as parent, and the company which is going to be taken over is known as subsidiary. So we can say a main head company and the branch company, like that. That's up to your discretion for the understanding purpose. So related party disclosure means when there is a parent subsidiary companies, the parent company might have any transactions or financial dealings with its subsidiaries. So that is known as that's the type of relations or financial dealings is known as related party transactions. And the financial statement of the parent concern should disclose all such type of transactions with its associates. Associates mean with its subsidiaries. So related party disclosure exactly represent the financial dealings of a parent concern with its subsidiary. It may be a subsidiary, or it may be a branch, or it may be a joint ventures, like that. So such type of transactions has to be presented as per the Ind AS 24. Next one, Ind AS 27, separate financial statements. Ind AS 27 deals with separate financial statements. The objective of this standard is to prescribe the accounting and disclosure requirements for investments in subsidiaries, joint ventures and associates when an entity prepares separate financial statements. Earlier we have learned about the business combinations where there are transactions relating to parent and subsidiary. In that case, we have mentioned that they will follow a consolidated financial statement. They will prepare a consolidated financial statement pattern. But sometimes the parent company has to prepare their statement separately. So in such situations, the financial statement prepared by the parent concern is known as separate financial statement, and it has to be complied as per the Ind AS 27. Next is Ind AS 28, investment in associates and joint ventures. As the title suggests, the investment in associate and joint ventures, the associates and joint ventures asset usually come in case of business combinations, basically transactions between parent and subsidiary, and in cases of joint ventures also. So whenever there is an investment in its associates mean it may be a subsidiary company or a branches, like that, and also in case of joint ventures, any transaction with regard to investments in associates and joint ventures by a parent concern, such transactions has to be prepared as per the Ind AS 28 if the company is following as per the compliance of the Ind AS standards. Next one, Ind AS 29, that deals with financial reporting in hyperinflationary economies or hyperinflationary economies. So before we go into the standard, you need to have an idea about what is meant by hyperinflationary economies. So before we go into hyperinflationary economy, we need to understand what is meant by hyperinflation. Hyperinflation is a term to describe rapid or excessive and out of control general price increase in an economy. We all know what is meant by, you might have heard the term inflation. Inflation is the measure of the pace of rising price of goods and services, whereas hyperinflation is rapidly rising inflation, typically measuring more than 50% per month. And usually hyperinflation is a rare event for developed countries, and it has occurred many times throughout history in the countries such as China, Germany, Russia, Hungary and Argentina. So what is with regard to the Ind AS is that in a globalized system, our companies in our country might have to trade or conduct business with the companies of other countries. So in that case, if the transactions with regard to other country, if it is a hyperinflated economy, the statements prepared by those companies will be presenting an information which may not be acceptable or which cannot be followed by the investors in other country. Because in a hyperinflated concern or a hyperinflated economy, the value or the prices keeps on rising at more than 50%. So in such cases, the financial statement prepared by those financial concern or corporate concerns cannot reveal the exact situation. So the investors may be scattered all around the world, and the financial statements of concern in a hyperinflated economy will represent another picture. So it will not be a helpful information for investors in taking decision. So Ind AS 29 deals with financial reporting in case of a hyperinflated economy. So in how the financial statement has to be presented. If it is working, if the financial statement of that concern, if that concern is working in a hyperinflationary economy, how it has to present a financial statement. And Ind AS 29 deals with financial reporting in case of a hyperinflationary economy. Next one. Ind AS 32, that is financial instruments and how it is to be presented in a financial statement. So the corporate concern or financial institutions or any type of companies that is complying with the Ind AS while presenting their details regarding your financial transactions with regard to financial instruments, it has to comply as per the Ind AS 32. The objective of the standard is to establish principles for presenting the financial instruments. It may be in the form of liabilities or in the form of assets, and this standard specifically mentions about what are steps that has to be followed while presenting the financial transactions with regard to the financial instrument of that concern. Next one, Indian Accounting Standard Ind AS 33, that means earning per share. You will learn in detail about the earning per share in the further accounting classes and in your next semesters. Earning per share means, from the term itself we can understand, what is the earning that has to be earned by a shareholder from one single share. For example, we know that the profits of a company is belong to shareholders because shareholders are the owners of the concern. So, how the profit of the company is to be shared among the shareholders? Usually it is done on the basis of earning per share. That's very simple. What is the profit or the earnings earned by the company? That has to be divided by the total number of equity shares. So that what is the earning that is earned by a particular shareholder on one particular share held by him? That is known as earning per share. And Ind AS 33 deals with how the earning per share is to be calculated, how it has to be presented in the financial statements while presenting the financial statement of the concern that complying with the Ind AS standards. Next one. Interim financial reporting. We have mentioned about this term in numerous cases in the previous classes. So, interim means anything that happens between two accounting periods, and interim financial reporting means reporting of financial statement in between two accounting period or in between two annual reports. Usually accounting reports or accounting final statements are prepared by the end of the accounting period, and in between two accounting reports or in between two accounting statements, sometimes the company might follow a monthly statement or monthly reporting concept or half yearly reporting concept. So any reporting in between two annual reports is known as interim reporting, and Ind AS 34 deals with how the company has to deal with interim financial reporting, how it is to be computed and presented, and company that complies with the Ind AS has to follow Ind AS 34 while dealing with interim financial reporting. Next one, Ind AS 36, that deals with impairment of an asset. The objective of the standard is to prescribe the procedure that an company or an entity applies to ensure that its assets are carried at no more than their recoverable amount. Because an asset is carried at more than its recoverable amount if its carrying amount exceeds the amount to be recovered through use or sale of the asset. If this is the case, the asset is described as impaired, or we can say impaired asset, and the standard requires the entity to recognize an impairment loss with regard to that particular asset, and the standard also specifies when an entity should reverse an impairment loss and prescribes disclosure. That is with regard to the impairment of an asset. Next, let us go to another standard. Next one, Ind AS 37, that deals with provisions, contingent liabilities and contingent assets. I believe you have heard the terms provisions, contingent liabilities and contingent assets. Provisions means the amount set aside for amount set aside out of profits to meet some specific purposes. You might have heard the term provision for bad debts, provision for depreciation, provision for tax. There is a specific purpose for that. For that, meeting that purpose, we will set aside an amount from our profits. Contingent liability means the liability that might arise in future. That is known as contingent liability. It will not be shown directly in the balance sheet. Usually, contingent liability and contingent assets are shown as a footnote. Just like contingent liability, contingent asset means asset that can arise in future. That is known as contingent asset. For example, lottery, winning a lottery. Lottery ticket is winning a lottery ticket means it is actually an event that has to happen in future. If we are going to win the lottery, then it is an asset. But if we are not going to win a lottery, it is not an asset. But we can't say that the lottery taken by us will not win or it will win. That is known as contingent asset. Just like that, there are some items, right, that comes under the contingent liability also. That is, if we own a company and someone might have made a case against us in the court. And if we fail in that case, you have to pay the compensation. Or if we win the case, we need not have to pay the compensation. So, contingent liability means if we fail in that case, you have to pay the compensation. But it doesn't mean that you will fail. So, it depends upon the future events. So, that is known as contingent liability and contingent assets. And Ind AS 37 deals with how the provisions, contingent liabilities and contingent assets are dealt by a concern while presenting their financial statements. Next one, Ind AS 38, intangible assets. I hope you all know what is meant by intangible assets. The objective of this standard is to prescribe the accounting treatment for intangible assets that are not dealt with specifically in another standard. This standard requires an entity to recognize an intangible asset if and only if specified criteria are met. The standard also specifies how to measure the carrying amount of an intangible asset and requires specified disclosure about intangible assets in the financial statements. I believe you have understand the point because we all know what is meant by intangible assets. Next one, Ind AS 40, that deals with investment property. The objective of this standard is to prescribe the accounting treatment for investment property and related disclosure requirements in the financial statements. And remember, the standard does not apply in case of biological asset. We had discussed about the biological assets, and in case of mineral reserves like that is oil, coal, natural gas, in such cases also. So that is with regard to investment property. And finally, last one, Ind AS 41 with regard to agriculture. Just like the title, this standard solely deals with any of the transactions or financial dealings with regard to agricultural activities and how it can be presented in the financial statements. So the objective of this standard is to prescribe the accounting treatment and disclosures related to the agricultural activity. There are certain companies that deals with agricultural area. So the financial statements with regard to their agricultural activity, how it can be presented, and Ind AS 41 deals with such practices of presenting the financial statements of a concern dealing with agricultural area. So these are the accounting standards that are currently in operation in our country. So go through all these Ind AS standards, familiarize each of the head and what are the contents of each of these standards. So go through all these standards, and if you have any queries with regard to that, please do let me know.